Get the best out of the markets again. You have witnessed it in 2016. 2018. 2021. Kotak Equity Colloquium is back. One of India's largest knowledge-sharing platform on the markets. The Kotak Equity Colloquium. From Kotak Mutual Fund, India's fifth largest mutual fund. Join the biggest names in the industry. Gain knowledge from their market insights. Get trends and analysis and the forecast for the future. Use their experience and share it with your investors. Deep dive into sectors which will drive the future, which may help you grow your money like never before. Get brand new perspectives and all the tools you need to grow your business. Inviting you to join the Kotak Equity Colloquium.
Good evening, friends. Welcome to Equity Colloquium for October 2021. It's been 11 months since we started this initiative to bring to you our views on different sectors through our teams of research analysts and portfolio managers. We thank you for your overwhelming support by joining us on this call every month and making the program a great success. This month, we are going to cover the steel sector. We have with us Harsha Upadhyay, CIO Equities, Shivani Kurian, Portfolio Manager and Head of Research, and Arijit Datta, Vice President, Equity Research Group, who will take us through the presentation on this particular sector. We will follow this program up with a Q&A section. So if you have any questions, you could type it on the chat box or the YouTube channel. Thanking you once again, friends. Just a request, if you like this session, please, do click the like button, subscribe to our YouTube channel, share this video with family and friends, encourage them to subscribe to our channel to go through the various video modules that we have on market outlooks, presentations on various of our Kotak mutual fund schemes. Without not taking much time, I will hand over the podium to Harsha to take this discussion forward. Thanking you all once again and welcome to Equity Colloquium, October 2021.
Thank you, Manish. Good evening, friends. Hope all of you have been doing well and staying safe. Markets have been on a roller coaster ride of late. There has been a significant outperformance that we have seen since the lows of COVID. However, in the last few trading sessions, we are seeing some sort of a correction starting to come by. I'm sure there will be questions about the earnings season, how the market is behaving now, what is likely to happen going forward, etc., which we will try to address post the presentation on the steel sector. Before we get into the presentation on the steel sector, maybe a couple of tidbits in terms of what has happened in the markets in terms of earnings. We are in the middle of the earnings season for September quarter. Just about 50% of Nifty companies have announced results until now. If you aggregate all the results that have come by until this session, we will see that there has been a slight improvement in terms of overall earnings expectations. Expectations were about 23.1% for the set of companies that have announced until now. And the actual delivery has been about 27.8%. So nearly a 5% improvement in terms of analyst expectation is what we have seen in the actual results. However, there are two important facts in this overall set of numbers, which would be pertinent to discuss as we are discussing steel sector in our presentation today. One, while we have seen better than expected earnings growth for September quarter until now, at the EBITDA level, most of the companies have seen some sort of a margin pressure, mainly coming through commodities, of which steel is also a part. So we could discuss that through the presentation as well as in our post-presentation interaction. The second key thing is most of the metal companies are expected to deliver strong results. We have seen a couple of steel names already announcing results, and the results have been much better than what they had announced in the previous quarter, in the quarter of the previous year, as well as compared to what the expectations were for this particular quarter. So these two things are key takeaways as far as metal sector is concerned for itself, as well as what its impact is going to be on the overall corporate India in terms of margins. This will be discussed in detail through our presentation on the steel sector as well, wherein our analyst Arijit Datta will be talking about the entire sector in terms of the demand dynamics. What are the supply issues? Where do we see the pricing? Where do we see the spreads? What is the outlook in terms of both price behavior as well as the demand supply situation as we go forward, and what it means to portfolio companies, for example. And to introduce Arijit Datta, while you may not have seen him in the previous edition of Equity Colloquium, he's a recent joinee, but he has got nearly 15 years of experience in the equity research area. He has joined us recently to cover metal sector, and he will be talking through the steel sector presentation and sharing his insights in terms of what is happening in the steel sector and what could be the impact on the overall corporate India in terms of profitability because of some of these movements. At this point of time, I'll request Arijit Datta to take the podium and present his views on the steel sector. Thank you, everyone.
Thank you, Harsha. Good evening, everyone. Steel. Steel is an unavoidable commodity in life. Like any other commodity, the price of steel is dependent on the demand-supply equilibrium of the metal. Currently, we are witnessing a decadal shift in the demand-supply dynamics of steel. Out of 2.3 billion tons of world steel capacity, China has 1.1 billion tons. In both production and consumption of steel, China accounts for more than 50% of the global, both in production and consumption. With this lion's share, it is the biggest determinant of steel prices. Just giving an example, say entire North America or say entire Euro countries are just 15% of total Chinese consumption. The next slide, we will talk about the demand supply drivers. So the biggest driver for steel prices is the government policy of China. So in the first slide, I've broken it into, in the first chart, I've broken it into 3 buckets of 15 years each. The first bucket was when China started reforms under then COP. In this 15 years, from 1986 to 2001, Chinese capacity increased by just 2.5 times. The second bucket is when China entered the World Trade Organization in 2001. The government loaded incentive to the steel producer, like subsidized land, cheap electricity, VAT credit to boost export. This resulted in increase of steel capacity by 8 times during 2001 to 2015. So from 2.5 times rise in the first bucket of 15 years, the capacity increased by 8 times during the next 15 years. This was a time when China realized the perils of relentless expansion. As the environment crippled with pollution, smog arising from industrialization took toll on health and environment, especially during the winter months. So in 2016, government decided the hard stop. It shifted focus to health and environment and imposed restriction. Since then, there is a decline of 5% till date, and barely any incremental capacity were allowed to come in the next few years. Hence, summing up the entire chart, government policy led to increase in steel demand by 2.5 times during 1986 to 2000, 8x in 2001 to 2015, and suddenly we are now in a declining zone. However, if you look at the capacity of the rest of the world, which is in the blue line, it has grown firmly, although at a slower pace, unlike China, but without any hiccup and in a stable way. The below chart is the impact of the above chart. Consumption in China failed to keep pace with the relentless expansion spree, resulting increasing gap in the capacity and consumption, which happened in 2001 to 2015. So the green line, which is the total export, if you look closely, it has actually doubled in 2 years from 2013 to 2015. From 2016, as capacity expansion stopped, consumption growth was still in the normalized pace, export intensity weakened. Let's move to the next slide with impact on prices. So here, if we look at the gray line, this is the Chinese export as a percentage to world steel production. And the blue line is the HRC prices. The below chart, if you look from 2011 to 2017, we have seen capacity utilization have plummeted in China. And this was a time when steel mills started pushing for export. So as the export as a percentage to world steel production kept on increasing, the steel prices has actually plummeted. Now, what has happened? Chinese export was more to boost the capacity utilization and not because of the global demand. Why? Two reasons. Number one, higher capacity utilization to give the operating leverage benefit. And second, exporting gets them incentive, which is in the form of VAT or sales tax rebate. Outcome, again, like steel prices have taken a toll. This is the point where we saw global steel companies went bankrupt. Even in India, we have seen many companies have gone under NCLT because they couldn't repay the debt. Next slide. So currently we are out of that. Going back to the previous slide, currently demand and supply is more stable as China is not exporting much. So here we see price trend to continue because of the four important factors. Number one, high capacity utilization rate in China in absence of new capacity addition since last 5 years and also for the next few years. Number two, abolition of export benefit means our competitor is not getting any subsidy, which in turn means better prices for the entire marketplace. Number three, demand strength is strong. We see many governments, especially in the Western world, are now focusing on infrastructure. This demand don't fade away quickly because infrastructure have a long shelf life in order till the completion stage. And the fourth one, weak capacity addition overall in the global economy. Now, who is the benefit? India to be the biggest beneficiary as it is the only nation globally to come up with capacity. Let me explain with some data points in the next slide. The first chart, high utilization rate in China. We have assumed only 1 to 2% YOY demand growth versus 8 to 10% demand growth in last decade till 2019 pre-COVID. For the rest of the world, although capacity utilization looks lower versus China, but we have to take into cognizance of the fact that many of the capacities are primarily idle permanently in the last down cycle from 2001 to 2015, especially in the Western world. So in order to view it on a practical purpose, the capacity utilization is much higher versus what is depicted in this chart. Just giving an example, average steel plant age in China is just 12 years. In India, it is like 10 years. But if you go in the West, it is 50 years. So bringing back to production for such old plant, which is already shut, are tough. The second chart shows us China's domestic steel prices were historically higher than the export prices. As exporters get incentive, China abolished this incentive from this year. And that's the reason why currently domestic prices are in fact 15% lower versus the export prices. there has been a shift in this two prices chart that we are seeing here. And that's the reason why we think that this gap, which is almost like $75, is a permanent addition to the steel prices. And this will directly flow to the EBITDA for the rest of the world, which has made it even stronger. Now, the third chart shows that in 2021 itself, global demand have fully recovered from 2020 COVID disruption, and it is now on an increasing trend. In the fourth chart, if you take 2005 to 2015 period, 100 million ton plus capacity was added. However, if you see from 2016 onwards till 2024, just 10 million ton is getting added. Hence, capacity addition pace has dropped 90% now. So who will be the biggest beneficiary on this? Answer is again India. The first chart tells us that there is no change in the capacity expansion momentum in India. The second chart tells us that the upcoming capacity expansion is by far highest globally for India. If you look at the third chart, it's very interesting. If you see the India share in the global expansion was historically below 10%. We are hardly a player in the global scheme of things. This is because China was dominant. Their expansion momentum was far higher. But now, with the same India's capacity expansion momentum, the share increased to average 40% over next few years of the global addition. So we will get the first mover advantage globally. Adding to that positive news, which we discussed in the last slide, all plant capacity expansion in India are brownfield expansion. Now, why it is positive? Cost of brownfield is just half of greenfield. The construction time is also half. You can build a brownfield in 3 to 4 years versus 6 to 8 years of greenfield. Hence, better return from the plant is almost guaranteed. An example, Tata Steel Kalinganagar plant. The first plant, which is a greenfield plant of 3 million ton, was built at rupees 23,000 cost. Now they're building the second phase, which is a 5 million ton plant. They're building it at a lower cost of only rupees 20,000 crore. The reason is it is a brownfield plant. Hence, all new addition will boost the return ratio profile. Now, in this slide, we are showing what has changed in India from 2016 in just 5 years. Here in 2016, we have taken the top 10 players in India in steel production. Now, because of the NCLT and the bankruptcy versus the 10 players, now we are currently only 6 players is surviving. And all the weak names are owned by the bigger and stronger players. For example, Usha Martin and Bhushan Steel is now owned by Tata Steel, and BPSL and Monet by JSW. Hence, the number of big steel players reduced from 10 to 6 in just 5 years. And RINL, which is on the block and companies are now in the bidding stage for that plant, this number will come to 5. So in 5 years from 10, practically we are just 5 players left. The consolidation will give big boost to the pricing power, at least in the domestic market, not in the export market, because steel is a global commodity. It can be shifted easily. But in the domestic market, the consolidation will give a better pricing power and stability to the industry. The next slide, which is about the balance sheet. Balance sheet is the most important thing in steel industry. The reason is it was the primary cause of bankruptcy that steel industry was plagued with in 2016. But in last 2 years, there was a dream run in profitability. So you can see that balance sheet was almost clean. So the sectoral debt to EBITDA level has now moved to just 1x of the EBITDA level, the debt to EBITDA level. So although expansion pipeline is strong from here on, because of the brownfield nature, there will be not much push to the debt level here on. So we will see debt level to be declining, even if we assume a normalized EBITDA here on. Now, this is an interesting chart. This is a global cost of production, especially the raw material cost and the price trend. The important part here is the last 2 months, what has happened. Even before that, and in the last 2 months, what we are seeing that steel price rally is actually driven by the raw material cost. In the last 2 months, the cost was broadly same, the total raw material cost. Hence, global steel prices were also flattish. But in the next slide, if we see the breakup of cost, there was an offsetting element in it. Iron ore prices declined by 50% in last 2 months. At the same point of time, coking coal prices increased by 70%. Result, total cost was flattish. It is relevant for India as Indian steel mills are dependent on domestic iron ore, that benefit of declining in prices will not come. But instead, coking coal prices, which has increased significantly, it will impact because we are primarily importing coking coal. Just to give an example, Indian iron ore prices are almost like 50% discount to the global steel, global iron ore prices. For Tata Steel, who have a captive mine, the prices is even lower. And Indian iron ore price volatility is much lesser versus the global peers. So for Indian mills, the global iron ore price increase was positive as Indian players cost was didn't change much because of the iron ore prices. But the same is for vice versa, which we are seeing. And coking coal impact is same both for Indian players and the global players. So for the global players, this gap in last 2 months is an offsetting event. But for Indian player, we will see a cost rise because we will not get the benefit of decline in iron ore cost, but we will be getting the pain of coking coal price increase. So the dream run of profit of Indian steel players are now already a past, and from here on, we will see profit will be squeezing. For integrated players like Tata Steel, this quarter will be the last quarter of super high profitability. So, but one thing here I would like to mention, even at this prices, the profitability is much higher versus the past. Only the supernormal profit that the companies were enjoying, that is going to be normalizing. This slide is more about the steel prices of India versus the global. So we are seeing the rebar prices, which was faltering till now, have started moving up. It is now having a catching up rally because post monsoon, the demand is now coming back because of the seasonality. Another comfort we have for the Indian steel players, that is the cost advantage. All the high cost and the inefficient players are out. Remaining players are very low and very efficient in terms of the cost. So all the Indian players which are marked in red line, if we red font, if you see the cost is much lower versus the global players. Why I'm putting it here? The reason is, even if in a down cycle, Indian steel players are going to be much safer versus the global peers. Another big thing, that on a per capita consumption basis versus the globe, India is much, much lower versus even China and even for the rest of the developed world. China versus India, our per capita consumption is almost like 112. So another comfort here, that demand momentum, at least in the domestic front, will be there. So overall, we are having a lot of positive push for the steel prices to be in a better level, and at the same point of time, India to be at an advantageous position because almost all the players are expanding, and on various parameters, India is much stronger versus other countries. The next slide is very important. It is the risk factors. Currently, the positive steel cycle assumption is based on two things. One is that Chinese capacity is not increasing. This we are very certain because a steel plant in order to be built takes 3 to 8 years. So we are sorted for the next at least for 4-5 years that no steel plant is coming. However, the demand growth, we are having a modest assumption of Chinese demand growth by 1 or say 2%. This is versus 8 to 10% year CAGR growth that we witnessed till 2019 for last 10 years. I mean, till pre-COVID. What if the demand momentum declines in China? Looks unlikely, but the threat is real. The reason is because of this three factor. Currently, government is pushing up a lot of regulation. I would say these are over-regulation. But there is a lack of communication. Nobody is aware of what government intend to do and how serious it is. And the third one is a lack of policy coordination. The government, interdepartment, even the provincial governments don't understand how seriously they are going to do and what they are supposed to do. And that's the reason why they are taking decision very vaguely and they're just pushing the regulation suddenly because they are afraid of the outcome or the pushback from the central government. All these three problems, the outcome is one, eroding productivity or weakening of consumer sentiment. Now, the second important chart is that the per capita consumption in China. If we see it is already at the peak, it has increased significantly in last few years. Now the consumption is per capita consumption is higher even compared to the Western world. What if it has reached the peak per capita consumption and from there consumption stagnates or declines? In that case, the total steel consumption will not, or steel demand will not be there. This is the second factor. And the third is the most important one. This is primarily because of Chinese action in last few months. Already we are seeing the impact as the government cracking down on the highly leveraged real estate industry. This can have a big repercussion because 40% of total steel demand in China goes to the real estate industry. And housing is 60% of average household net worth in China. So any decline in the property prices or the property market as a whole can lead to weakness in the consumer sentiment. Already new start, we are seeing a sharp drop in the new constructions start. And if you look at the land sale that happens in China, the drop was even 80% kind of thing. Nobody is now interested in the property market. So the risk is real. And if China declines, which we never see in history, if that happens, then only there are risks to the entire steel thesis. But historically, even 1 to 2% increase that we are taking in the demand growth is very low in number. So this is versus 8 to 10% what we witness in the entire last decade. So as of now, we are already conservative, and that way we are seeing that the outlook is very bright for the steel sector as a whole. So in a nutshell, if I sum up the entire slide, role of China is now changing. From growth focus in last 2 decades, it is now focusing on health and environment. China's decarbonization drives implies that it will produce less steel. That means it will curb the export. That will result in lower steel volumes in the export market, which is positive for the steel prices. India to be the biggest canner, and as India's steel company are on expansion spree, and it constitutes 40% of the global capacity addition. And this is the first time where we are seeing Indian mills will have debt reduction in spite of high capacity addition, that is because of the brownfield expansion. This will lead to FCFF, which is after capex. The FCFF generation will be high, so debt reduction momentum will continue. And as we just discussed, the risk is China's growth is slowing. If the government don't give stimulus enough to revive the economy, demand contraction means the steel mills will be forced to export, and that will be a threat to the global steel prices. Now, what assumption we are taking in the entire thing? We are basically building in around $650 to $700 of steel prices because $70 addition was guaranteed because China is no longer giving that rebate. This is versus 525 to 550 average steel price in the last decade. Now, although it is like a 20-25% increase versus the earlier steel prices, if you look at the current steel price, it is at $980. So we are building in from $980 steel prices to normalize versus the current prices. And as you know, the current $980 price is because of the raw material price rise. Currently, for example, coking coal is at $525 a ton. This number is absolutely out of the world number. This is higher than even double of the higher than double of the highest point that we ever seen in history. So as this prices normalizes, without affecting much to the margin, steel prices will also come down. So in the short-term outlook, that as steel prices will come down, never in the history we have seen steel prices are weakening and the share prices are moving up for companies. So there can be a period where steel sector will be showing some weakness in the share prices. But as the prices normalize into 650 to 700, we will have a golden run in the steel sector, steel space as a whole, because of the higher profitability, higher volumes, and better EBITDA. Thank you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.